Welcome to Iron Financial. This is the only place we stress test the market's biggest stories to help you forge a stronger portfolio. I'm your lead analyst. Today, we're putting Boeing directly on the anvil. The stock absolutely jumped after what the street is calling a massive earnings beat. And you know what? The bulls are screaming from the rooftops that the turnaround is finally here. But our job is to look past that initial flash and inspect the actual structural integrity of the company. We're here to find out if this is a solid foundation you can build on for the long term, or if it's just a gilded trap waiting to spring on unsuspecting investors. And joining me, as always, to keep this analysis brutally honest, is our market skeptic.
That's exactly right. The market sees a headline beat, the algorithms start firing off buy orders, and it is so easy to get swept up in that momentum, in that hype. But my question is a whole lot simpler. Is this real operational strength we're seeing, or is it just some clever financial engineering designed to make one quarter look good? I mean, really, is this a company you can confidently add to your portfolio for the long haul, or is this just a speculative trade that's built on a foundation that's full of cracks? We are about to put this entire earnings report through a serious inspection. We're not just looking at the surface, folks. We're going to test the welds, and we're going to look for the stress fractures.
Exactly. And before we start applying that pressure, we have to acknowledge the facade because it is impressive. To really understand the risk, you first have to understand what has the market so optimistic, so excited. So let's dive right in and lay out these top-line numbers that are fueling this rally. Because you have to admit, on the surface, these figures, they look incredibly strong.
Okay, let's just start with the top line. $22.2 billion. That's the revenue for the first quarter of 2026. Now, this isn't just a number on a page. It is a statement of raw industrial might. It tells us that despite all the negative headlines we've seen, despite the supply chain nightmares, despite the intense operational challenges they faced, the core business of building and selling these massive, complex machines is still a revenue engine of incredible scale. In a world that's obsessed with software and services, this is raw industrial power. And it's a figure that absolutely commands respect. But here it is. This is the number that really lit a fire under the stock price. A core loss per share of just 20 cents. Now, on its own, a loss is never, ever a cause for celebration. But in the world of finance, everything is relative. Everything is about expectations. Wall Street consensus was bracing for a loss of 85 cents per share. So this isn't just a beat. It is a monumental 76.5% beat. This is the single data point that signals to the market that management is finally getting a handle on costs, that operational efficiency is improving far faster than anyone predicted. This is the number that is screaming to Wall Street. The turnaround is real.
And look, you don't have to take my word for it. The reaction from the financial press was immediate and it was crystal clear. Alpha Street called it a solid beat. That kind of simple, declarative language is exactly what gets the big institutional money off the sidelines and into the game. It's a stamp of approval that validates the bull thesis, at least at first glance. So the initial verdict from the street was unambiguous and it was overwhelmingly positive. Boeing is back on the right track.
All right. I see the numbers. They're big, they're shiny, and that earnings beat is, I'll admit, impressive. The market absolutely loves a good surprise. But that's the surface. That is the fresh coat of paint they slap on right before the open house. And here at Iron Financial, we do not invest in headlines. Our job is to take a ball-peen hammer to the I-beams and listen for the sound. Is it solid all the way through, or is it hollow inside? It's time to go past this gleaming surface and start a real, proper structural analysis. And that is absolutely the right approach. A big beat is one thing, but the quality of that beat is everything. We need to break down this revenue engine piece by piece. Is this growth actually sustainable? Is it coming from high-quality sources? Understanding how they forged this $22.2 billion number is absolutely critical to determining if this is a durable recovery or if it's just a temporary surge that's going to fade away by next quarter. And this chart here, it illustrates the momentum perfectly. We are looking at 14% year-over-year revenue growth. They've added nearly $3 billion to their top line compared to this exact same time last year. Now, for a company of this sheer scale, a 14% expansion isn't just a small step. It is a significant, powerful leap. That is some serious heavy lifting. It's the first clear sign we're seeing that the operational tempo is finally increasing, which is exactly what you want to see in a healthy industrial giant.
And the crucial point here, the thing you have to understand, is that this revenue growth isn't just some accounting trick or favorable timing on a services contract. No, it is forged in steel and aluminum on the factory floor. Just look at the deliveries. They pushed 143 commercial airplanes out the door in the first quarter. That's up from 130 in the same period last year. More 737s, more 787s. You can't fake deliveries. This is physical, tangible proof of progress. It means the production line is moving faster, and that is the absolute heart of the bull case. They are finally starting to convert that massive backlog into recognized revenue.
Okay, lead analyst, I get it. I really do. Deliveries are up, revenue is up, the bulls are having a party. But as the old saying goes, revenue is vanity, profit is sanity, and cash is king. So far, all we've talked about is vanity. Now it's time for the sanity check. It is great that you're moving more metal, but are you making any money doing it? This is where we take our tools to the foundation of the company and start looking for the cracks. And trust me, they are not hard to find.
This is the question. This is the question that every single investor, whether you're a bull or a bear, needs to be asking themselves right now. Don't be mesmerized by that 14% growth figure. I want to know what it cost them to get that growth. What is the actual profit margin on those new planes rolling off the line? And after all the expenses, all the capital expenditures to keep the lights on, how much cash is actually flowing into the company's treasury? Or, maybe more to the point, how much is flowing out?
And here it is, the first major stress fracture in the bull case. Just look at these numbers. Despite the higher revenue, despite the much-celebrated earnings beat, the company is still incinerating cash. Operating cash flow was negative $179 million. But the real gut punch, the number that should make you pause, is the free cash flow. After they account for all the money they need to spend just to keep the factories running, they burned through $1.5 billion in a single quarter. Now, the bulls will tell you, oh, it's an improvement from the $2.3 billion they burned last year, but you cannot call a $1.5 billion fire an improvement. It is still a 5-alarm blaze. A healthy company generates cash. It doesn't burn it to a crisp.
So where is that cash burn coming from? It's coming from right here. This is the core of the problem. The entire company, all divisions combined, managed to eke out a tiny 2% GAAP operating margin. But the commercial airplanes division, the very division that's driving that 14% revenue growth, is still a black hole for profits. It's running at a negative 6.1% operating margin. Just think about what that actually means. For every dollar of revenue they bring in from selling their flagship products, they are losing over 6 cents. They are literally paying customers to take planes off their hands just to hit a revenue number. This isn't a solid foundation. This is a critical structural weakness that is dragging the entire enterprise down.
And that persistent cash burn, driven by those awful negative margins, puts the balance sheet under immense pressure. This is our stress test. So on one hand, they have a respectable cash pile of about $21 billion. That seems like a solid buffer, right? But look at the other side of the ledger. They're carrying over $47 billion in consolidated debt. That is a colossal weight on the company's structure. When you are burning $1.5 billion in cash every 90 days, and you're servicing a debt load that's more than double your cash reserves, your margin for error is razor thin. This is not a fortress balance sheet. This is a company under significant and absolutely undeniable financial strain.
You've identified the cracks, and they are absolutely real. No one can deny the cash burn or the margin pressure they're facing from legacy programs and supply chain issues. Those are the known risks. But any structural analysis that only focuses on the cracks is incomplete. You also have to account for the massive load-bearing columns that support the entire structure. And for Boeing, the bull case rests on the single most powerful asset they have, the backlog. This is the counterargument to every single point you've just made, and its strength is undeniable. Look at that number. Just let it sink in for a moment. $695 billion. That is the total company backlog. It is a record high. It represents years, nearly a decade of guaranteed production and revenue visibility. In a cyclical, uncertain global economy, having nearly $750 billion in confirmed contractual orders is the ultimate safety net. It's the ultimate moat. This is the single biggest reason why Wall Street is willing to look past the quarterly cash burn. This is the mountain of demand that gives them the time they so desperately need to fix their internal operational issues.
And let's just break down where that strength comes from. The lion's share, over $575 billion, is in commercial airplanes. That represents over 6,100 planes just waiting to be built. But notice the diversification here. There's nearly $86 billion in the stable, government-contracted defense, space, and security business, and another $33 billion in the high-margin global services division. These other segments provide a solid, profitable base for the company. So while the commercial airplanes business is working through its margin issues, the entire structure is supported by robust demand across every single one of its segments. This is not a one-trick pony.
A fortress of future revenue. You know what?
I will grant you that. The demand is not the issue. The backlog is immense. It is a powerful economic moat. But a fortress is only as strong as the people defending it. The question has never been about the size of the order book. The question has always been, and it remains today, can they execute? Can they turn that $695 billion fortress of orders into profitable, cash-generating deliveries without the constant operational stumbles and cost overruns we've seen for years? Because a backlog doesn't pay the interest on $47 billion of debt. Cash does.
And that is the perfect pivot to our final verdict. We have seen the gleaming surface of the earnings beat, and we've stress-tested the foundation, exposing the very real cracks in profitability and cash flow. But we've also acknowledged the massive load-bearing structure of that backlog. So now it's time to weigh all the evidence. For the investor looking to forge their portfolio, is Boeing a generational opportunity to buy into a global champion, or is it a classic value trap?
So let's put it all on the table, right here, head to head. The bull case is clear and it is powerful. 14% revenue growth shows undeniable operational momentum. The massive earnings per share beat suggests management is executing better than anyone expected. And that record $695 billion backlog provides incredible long-term visibility. But the bear case is just as compelling. The foundation is weak. They are still burning $1.5 billion of cash a quarter. The core commercial airplane business is deeply unprofitable with those negative 6.1% margins, and the whole structure is being weighed down by a $47 billion debt load. This is the fundamental conflict that every investor has to resolve for themselves.
Ultimately, the long-term viability of the company and the entire bull case really comes down to this picture right here. Global demand for air travel continues to rebound and grow. Airlines all around the world need new, more fuel-efficient aircraft to meet that demand and to replace their aging fleets. There are only 2 companies on the entire planet that can build these planes at scale. This powerful secular tailwind is what feeds that massive order book and gives Boeing the time and the opportunity to fix its internal production problems. The demand is real, and believe me, it is not going away anytime soon.
So here it is, the iron verdict. The blueprint for this company, its technology, its duopolistic market position, and that incredible order book, it is absolutely world-class. It is a plan for a skyscraper. However, the foundation, the profitability, the cash flow, the balance sheet, that is still curing. It is not yet ready to support the full weight of its potential. This is not a finished structure. Therefore, our verdict is that this is an investment for patient builders only. It is for those with a long time horizon who are willing to withstand the inevitable volatility as this concrete foundation slowly sets and strengthens over many years. This is not a project for traders looking for a quick flip.
And that leaves us with the final question, which is for you to answer. You have seen the evidence. You see the incredible strength of the $695 billion backlog, a true fortress of future demand. But you also see the very real cracks in the foundation, the cash burn, the negative margins, and the heavy debt. Knowing all of this, is Boeing a risk that you are willing to build into your own portfolio? Is the potential reward of this world-class blueprint worth the very real risk of a foundation that is still a work in progress? The choice is yours. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.